Okay, let's pick back up with a discussion about the financial budget. And the financial budget is, of course, directly related to all of the information that has been put together throughout the operations budget. Okay, so starting up at the top with the sales or revenues budget, the information trickles down through all of the formulas, populating all of that information, end with the budgeted income statement, and then we need to pick up there and move into the financial budgets area. I mentioned in one of the earlier videos that the capital expenditures budget is covered in the latter part of your textbook. Again, this is a textbook that if any of you plan on getting into industry, whether soon after graduation or after working at a CPA firm for a couple of years, this is a textbook to keep. Okay, so this information really doesn't change much. You can pick this back up later and look at it again, so I would hang on to the textbook. But the capital expenditures budget, you would be talking about how much the company plans to spend in the upcoming period for property, plant, and equipment, and capital improvement projects. And of course, typically these are large dollar amounts of money that need to be available so that the investments can be made. Okay, so we would get that information gathered together for that capital expenditures budget, and we are going to pull numbers from it that get plugged into what is called the cash budget. Okay, so we understand from accrual accounting that we recognize revenues on an accrual basis when they have been earned, whether or not we have received payment yet. We also recognize expenses, whether or not we have paid them yet. Okay, so the budgeted income statement is on that accrual basis. Well, that is not giving us a full picture of when we are going to expect payment, when we are going to receive those payments from customers, and any other incoming cash streams from maybe sales of stocks or bonds. Maybe we have made loans to other entities or individuals. Okay, those are all inflows of cash that we are going to expect at some time. Also, we have got bills to pay. Okay, so we need to have all of these numbers gathered together in one location so that we can better manage our actual cash. And that brings us to the cash budget, which I'm going to bring up here in just a moment. The cash budget, of course, is interrelated to the budgeted balance sheet. We are going to calculate an ending number for our cash balance per the cash budget as of the end of the period. So we are going to pick that number up off the cash budget and carry it over to the budgeted balance sheet. And we could also pick up a lot of our numbers, of course, from our entire budget and do a budgeted statement of cash flows, breaking all of the information down into those distinct areas of operating, investing, and financing, sources and uses of cash. All right, so let's go now and take a quick peek here in this document of what this cash budget looks like. So I'm going to scroll down here so we can pull this up for you if I can find the right page. It's maybe this one right here. All right, here's our cash budget that corresponds with the textbook. Notice that we've got cash balance beginning. This $300,000 is picked up off of the balance sheet from the prior period. Okay, so this is our ending balance from the prior period. Now, typically when a company is putting their budgets together, we are doing this months in advance. Okay, so we're not doing this on December 31st and coming in the next day. This actually takes a while to put all of this information together. So many times this number right here is actually going to be our budgeted cash balance from the budgeted balance sheet from the prior period. Okay, so you would pick that number up and plug it in this box. Next, what we do is we go and we add the receipts, any type of incoming cash that is expected. Now, for our version here in the text, they're keeping it fairly simple. We only show receipts from collections from customers. But again, if we were planning to sell off any stock, if we've got collections coming in from loans that we may have out with individuals or other entities, if we plan to collect on any bonds that we own in other entities, etc., those things would be showing up as cash inflows here. Let's go take a look at how this calculation here is done because it can be quite involved. All right, so let's go take a look at our textbook. Here I am on page 228 in the 15th edition. And what we need to do is plot out when the sales are made or budgeted to be made, how much we are going to sell them for, and calculate the dollar amount in revenues, and then figure out, based on historical information, how do our customers tend to pay us. All right, so if we go and look at a breakdown of our budgeted sales revenues budget, we can see that we are expecting to sell 12,270 units of the casual in quarter 1 at $600 a unit for a total of $7,362,000, and then 2,400 of the deluxe model at $800 per unit for a total of $1,920,000. If we put those two together, we expect total sales of $9,282,000 in quarter 1. We can see that the information is being calculated for quarter 2, quarter 3, and also quarter 4 based on patterns of growth and encompassing information from those sales and marketing people who have done their sales forecast. We believe we're going to be able to sell an increasing number of units going forward, and we are going to be able to hold our sales price per unit. Okay, so we would need to calculate the budgeted revenues for each one of those quarters. And then we are going to consider how those customers tend to pay us. All right, so if you look down here in this paragraph, it says we estimate that 80% of all sales made in a quarter are collected in the same quarter. Now, you guys have really got to get this down pat and writing this information out and being able to calculate it. If you plan to take any type of certification exam related to accounting in some way, shape, or form, whether it be the CPA exam, the CMA exam, or any of those financial exams, I can assure you, you are going to see some problems like this that you have got to be able to calculate out inflows of cash and outflows of cash broken down by months or quarters. So what would I be writing down right now in the information of the fact pattern? 80% in month of sale or 80% in quarter of sale. All right, so 80% will be collected in the same period the sale is made. Somehow make a notation of what that 80% stands for. And then the remaining 20% of the sales from that month or quarter that you're calculating is going to be collected in the period after. Okay, so we're talking about quarters here. So I would be writing down 20% QAS for quarter after sale, where my 80% would be QOS, quarter of sale. And then you've got to apply that to this information up here, and we need to calculate the streams of incoming cash broken down by quarter so that we can go put this in the cash budget. All right, so if we scroll down just a touch on the page, you can see how this can be written out. We've got the quarters at the top of the columns, and then we need to start plotting in the information and doing a calculation. Now, 20% is expected in the quarter after sale. Okay, so the sales from the fourth quarter of the prior year are going to be collected in the first quarter of this year. Okay, so we would need to go and find what are the expected sales for the fourth quarter from the prior year and multiply that number times 0.2 and plug that in as an inflow of cash for quarter one. Where else would this information be held? We could go and look at the budgeted balance sheet for the prior period, and that accounts receivable balance is going to hold that number. All right, so we could go and find this a couple of ways. All right, now for our calculations for this year's sales and how we expect those payments to come in. Again, go back up to the top. What is our expected sales for quarter one? Quarter of sale, 80% is expected to be received. So we would take that 9,282,000 and multiply it times 0.8 to give us $7,425,600 and plot that into quarter one. Notice that the prior year's fourth quarter balance due from customers plus the 80% quarter of sales in quarter one gets added up, and $9,136,600 would then get carried over and put in the quarter one box for cash collections from customers. We can then go and look and see that the remaining 20% of first quarter sales would be expected as payment in QAS, or quarter after sales. Okay, so quarter after is the second quarter since the sales were made in the first quarter. You could take 9,282,000 and multiply it times 0.2 to get this number, or you could take 9,282,000 and subtract what you calculated for first quarter collections. Mathematically speaking, either one works. Whichever one makes your brain happy is the one I would suggest that you get used to using. Now, I do want to mention here that these calculations for a cash budget for a period of time can actually be quite a bit more involved than this little 80-20 example that we have here. Think of the fact that back in Principles 1 and also in Intermediate 1, you guys should have been discussing the fact that just because we agree to sell customers on open account, not every single one of those are actually going to pay us. Okay, so we would have to make some estimates regarding how much is actually uncollectible. Okay, so you could see some very involved calculations, especially if you are planning to study for some of these certification exams, where you may have to consider uncollectible and breaking out, for example, 5% that doesn't even get to show up as cash collections. Also, this is a fairly easy example here because we've got it broken down into two distinct quarters only. Okay, so quarter of sale and quarter after sale. What if the payment terms are a little more difficult than that? You may have multiple quarters beyond just two that the payment stream needs to get spread out. So you could have a whole lot more calculations and columns of information that have numbers in them. All right, so just forewarning, be prepared. Going forward in your education and your certifications, you may see some more involved calculations. All right, so we would do the same type of thing for the second quarter sales, for the third quarter sales, and finally the fourth quarter sales. Now, notice again, we're still using quarter of sale and quarter after sale and plotting those numbers in. And then we total the columns to give us the dollar amounts that get carried over to the total collections from customers on the cash budget. But I do want to highlight down here regarding the fourth quarter sales that we've got some additional information that we can use in here that will get carried over to our next item that we're going to do after the cash budget, that budgeted balance sheet. All right, so fourth quarter sales, quarter of sale, 80% will be collected. So we will use that number in our calculation for the fourth quarter collections. But what about that remaining 20% that hasn't been collected yet? If you were to calculate that remaining 20% number, that is going to be your accounts receivable balance on your budgeted balance sheet. All right. So mathematically, taking the 8,140,000, multiplying it times 0.2, you would get a number. You could also look at it as 8,140,000 minus what is to be collected in that quarter of sale, the 6,512,000, would leave us a resulting dollar amount somewhere close to $2 million that's going to be sitting out there as accounts receivable. All right, so these four columns, their totals gets taken over and put on our cash budget. All right, so that's the dollar amount we would have as inflows. Now, how do we proceed with filling out these columns? I want you to notice that we've got cash balance at the beginning, add receipts, collections from customers total for quarter one, gives us total cash available for needs. And we're going to take this number and we are going to proceed down quarter one with these other items that I'm going to show you here in a few moments, and come to a cash balance at the bottom. This is our cash balance per our budgeted period at the end of quarter one. This is the dollar amount that is going to get picked up and carried back up and put in the top of quarter two. And then we would proceed with adding those cash collections from quarter two and proceed on down that column, getting a number at the bottom of quarter two, carrying it to the top of quarter three, carrying it through the quarter three column, picking back up at the top of quarter four, going through everything again and ending with a number. Whoops. And this number at the bottom of quarter four is our cash balance at the end of the period. And this number is the one that's going to get picked up and put on our budgeted balance sheet. Okay? So let's continue looking through here what all's on our cash budget. Based on our scenario, how do we plan to pay for our direct materials? How do we plan to pay for our labor? How do we plan to pay for our manufacturing overhead cost? How do we plan to pay for all of those other items that we had out there? Those non-manufacturing costs, that research and development, all of those other selling and administrative type costs and expenses. We have a typical way that we pay these bills, okay? Hopefully we pay within the terms that we've been granted to keep our good credit. But we're going to have a schedule of how we go about paying those. So we can go back, pick up in our textbook, and let me find our calculations here. They may be on another page. And we may not even have them in here. Let's see. It's a little hard to do this. I'm trying to pull up items for you guys to see at the same time I'm trying to find the exact page that the information's on. Okay, here in the 15th edition text on page 226, it talks to us about how we go about paying our bills. Okay, so cash disbursements. Our direct material purchases, we pay those suppliers and those vendors. They are paid in full in the month after the goods are delivered. Now again, this budgeting people can be very involved at a company. All right, we've got a lot of calculations to make above and beyond when we put those operating budgets together. We've got to calculate when we're going to receive payments and when we're going to make payments based on when purchases are made, based on when our wages are earned and things like that. Okay, so in the month after the goods are purchased. So this could be very involved in our calculations. Our direct manufacturing labor and other wages and salaries are all paid in the month in which the labor effort is incurred. Now that's fairly easy for us because we can just go and pull the direct manufacturing labor items off that direct manufacturing labor budget. We can go and then also pull off the salaries that are listed on the other operating budgets. For example, if we've got any research and development salaries, if we've got our corporate salaries on a salaries and administrative expense budget, we can go and find all of those, add all these items up, and carry them over to the cash budget and plot them in to the particular quarter that those charges would have been earned by those people working for us. This direct materials purchases, of course, we're going to go back and we're going to pull that information off that direct materials budget. Any other costs and expenses that we may have here for our example in the text, they are being also simplified here. They're being paid in the month in which the cost is incurred. Okay, so thankfully they're keeping it simple for us for you guys to work through. But again, keep in mind going forward in your career, this could get a lot more involved. Again, they've notated here, recall I mentioned this earlier, that depreciation is not a cash expense, okay? It's just a journal entry where we go to reflect depreciation, amortization, or depletion of assets that were purchased or invested in earlier. So do not include on your cash budget dollar amounts that have depreciation, amortization, or depletion in them. You need to subtract that and back it out. I had mentioned the capital expenditures budget. Based on any of those type of long-term investment plans, we would need to plot out on our cash budget those outlays. All right, so in advance, we're putting this cash budget together because management needs to know in advance what the cash flows are really going to look like, because we need to do planning so that if we have shortages of cash, that we make arrangements to obtain more. Whether we, issue some bonds, we go to the bank, we borrow money, maybe we sell off some old property, plant, and equipment, or other things that we can get that cash in from. Also, if we've got excess cash, okay, we don't want it to just be sitting there idle in a checking account earning next to nothing in interest. We should make better use of those funds. Do something with it to make a return on that cash. Okay, so management does all this for a reason. In regards to our particular company, management is always going to have a threshold, a minimum amount of cash on hand at any point in time, because they want to feel safe and secure. If an emergency was to arise, do we have adequate cash? If something came to light that was an excellent opportunity, would we have enough cash on hand for us to have to be able to take advantage of that opportunity? All right, so in our particular example here, I want to say we have got a minimum balance requirement. Let me see if I can find it in my notes. They have definitely got a minimum that they want to keep. And I'll have to find it here in my notes, but I can assure you that they definitely do want to maintain adequate cash. Let me see if I can find it. Okay, I found it here on page 224. They want to maintain a $320,000 minimum cash balance at the end of each quarter. Okay, so when we are going about actually seeing the cash balance columns filled out, if we happen to get to the bottom after we have totaled all of our disbursements based on how things get paid, and then subtract that from the total cash available for our needs, if our number is below that, then we are going to need to borrow some. All right, so total disbursements is here. Minimum cash balance desired is here. If we subtract those from our total cash available, you will notice that we have a deficiency. All right, so $1,940,846 is going to be needed to take us above and beyond the $320,000 threshold. All right, so we would need to borrow that money. Now notice here that they rounded, so be careful on your MyLab. Make sure that you guys read the fine print. If they are asking you to do some rounding, how you go about calculating things, make sure you use caution. Now you will see though, however, I've been exceptionally lenient and built in for you guys to have 4 attempts per question. So take advantage of that, but try to be very thorough when you are calculating your numbers to plug those in. All right, so we have worked our way through here. Our cash balance at the end, we would go and borrow the money, and that would put us back at $320,154. Again, taking this number, carrying it back to the top, putting it in for quarter 2, and going through the same items here. I do want you guys to also see that we've got a capital expenditure that has been planned well in advance. They are planning to make an investment in some machinery in quarter 3, and we're going to have those cash needs of $758,000. Okay, so we've planned for that in advance. And I also want you to see that we even have plotted in here our income taxes. All right, so typically companies are making quarterly estimated payments in advance as they are earning those revenues and that resulting net income. And we need to be sending those checks to Uncle Sam in advance. So here you can see that we have $725,000 plotted in during quarter 1. This is most likely quarter 1's incomes amounts taxed at a given percentage, and any payments required from the prior year at the end of that fiscal year when that tax return for that prior year is done. All right, so all of those need to be also added in to our cash budget so that we plan for having to send those checks. Let's see if there's anything else I need to make sure and show you on here. Depending on our payment terms on our financing, we like to pay those items off, those loans, as soon as possible, because as we know, any of that outstanding loan is going to be accumulating some interest expenses on it. So in order to keep our interest as low as possible on our interest expense on our income statement, when we have adequate or excess cash, we need to be paying off those loan items. So here you can see that based on the amount of excess cash, we would be paying off the loan as best we can. So here in quarter 2, we've got excess cash above and beyond the $320,000 minimum. All right, so we would then take that amount and pay off as much of our debt and interest at that time. All right, so here's the $846,000 towards the principal of the loan, and here is the interest on the loan at that date. All right, so we'll do that time and time again. If we do not pay off all of the remaining loan, at the end of quarter 4, we would have a balance due, notes payable on that budgeted balance sheet. Okay, so think of the fact that all of these payments towards these bills are going to pay off those costs and expenses, but anything that remains unpaid at the end of fourth quarter is of course going to be a remaining liability. All right, now again, they kept this simple for us on many of these. All right, because this payroll, as an example, they said it was going to be paid in the month and therefore the quarter that those salaries and wages were earned and, of course, made as expenses on the income statement. So thankfully, we're not going to have some of these as liabilities. So again, they left it simple for us for the most part. So once we're through with the budgeted cash budget, we then can do our budgeted balance sheet, pulling many numbers from many locations. So let's just kind of run through here how this works. All right, here's the balance sheet for the prior year. Again, this $300,000 would also have shown up as our budgeted cash balance for the budget for the prior year. All right, so while we're doing this planning, we could have picked this number up from one of two places. Our budgeted balance sheet from the prior period, the actual balance sheet from the prior period, or even that cash budget for the prior period. And we would then be able to fill out our cash budget and then pull from quarter 4 the bottom line. What do we expect to have in cash at the end of the period? Again, that number, this $395,390, came from the cash budget. Our accounts receivable is that 20% remaining from fourth quarter's sales. Okay, so fourth quarter sales revenues times the 20% for the quarter after sales that would be collected in the first quarter of 2015. So this is our accounts receivable number. Our direct materials inventory, based on how we pay for our items and how we use our stuff. Direct materials inventory, these are the raw materials that we plan to have at the end of the fourth quarter, literally still in our possession and available for use. Okay, so if you were to go back and look at that direct materials budget, what is our desired ending direct materials or our target ending direct materials, whichever words you prefer to use, and what is our planned cost for those, and multiply that out, and that's what this value is. This is in dollars for those direct materials units at their respective cost to us for the period. Same holds true with the finished goods inventory. Again, these are our assets. How many finished goods units do we plan to have on hand at the end of the period? That finished goods inventory goes back to that schedule that was prepared. Recall that we were able to calculate a cost for those goods manufactured, and so many of those units are still here as finished goods, and this dollar amount is the calculation, the result there for the value for those target ending number of units and finished goods at their respective cost. All right, so there are all of our current assets totaled up. For our land, building, and equipment, we had $2 million worth of land coming over and $22,758,000 in buildings and equipment. Now, you guys should have this stuff down pat after principles and your intermediate courses, but let's just talk about it lightly. We could have found our land and our buildings and equipment on the prior year's balance sheet. We, of course, would need to add the purchase of machinery that was made during the year to our buildings and equipment from the prior year's balance and plug these numbers in. And then our accumulated depreciation is going to be the balance sheet value from last year plus all of the depreciation expense, etc., that was taken this year. So go and find the income statement, our budgeted income statement, pull out those depreciation expense items, amortization, etc., and add those up to the accumulated depreciation from the prior year. And that's where this number came from. All right, so if we take property, plant, and equipment less its accumulated depreciation, then we get their net balance. All right, adding those two together, we've got, of course, our total property, plant, and equipment, including our land, and we've got the total of assets here. Again, our liabilities, based on how we pay our bills, we may have some still unpaid. All right, so accounts payable could include any direct materials, those vendors and suppliers that still have an unpaid balance. All right, so that's where that $775,700 comes from. How did we pay our bills? What would be paid in the first quarter of 2015 based on your calculation? Then that is your liability for your budgeted balance sheet. Same holds true with income taxes payable. Whatever has not been scheduled to pay on that cash budget is going to be your income taxes payable that would get paid in the following year. Right? So calculate those numbers. It's easy math, people. Just plug it in. Common stock, I don't believe we issued any additional stock this year. But if we did, of course, that number would change. Retained earnings, you guys should know the formula. Basically, you're talking at the retained earnings from the prior period on the balance sheet from the prior period. All right, so go and find that number. Add to it net income. If we happen to have an example where dividends were paid, we would, of course, be subtracting that and then plugging in right here our new retained earnings number. And of course, you guys can see we've got our total liabilities number over here and our total equity number over here, and those two get added together to give us total liabilities plus total equity. And of course, that number is definitely going to match up with our total assets for the period. Now, we could take this a step further and we could go and do the budgeted statement of cash flows so that we can see it in all its glory on a cash basis, what those operating, investing, and financing activities would look like on that statement of cash flows, because we do know that those investors and those creditors like to take a look at that as well. And they've got a lot of ratio analysis that they do in taking a look at those results. And we know that our company will be evaluated on that. All right, that is the end of the financing budgets for our Chapter 6 that I'm going to discuss. I will make sure you guys also get a copy of some information in advance of starting Chapter 7. I do have a couple of other things that I want to mention to you. Budgeting is not just for manufacturing companies. Okay, it is also utilized by governments, of course. Of course, we've got that going on, that fiscal responsibility. But nonprofits can use it. Service companies can use it. So it's just as important for them as well. The budget process, however, for those people or those types of entities does differ. Okay. For example, if we were going to talk about a nonprofit, they are going to be doing their budget on the basis of their cash flows, their expenditures, and their receipts, not on a revenue and expense basis like a for-profit entity would do. Okay, so for a nonprofit, they would literally start with their expenses, their expenditures, not their receipts. And then their management's task would be to find receipts or donations needed in order to adequately support those planned expenditures. Budgets must be followed. Overspending is often illegal for many types of nonprofits and governmental entities. For our service companies, it's very important that they budget, because if we do not coordinate our staff and the underlying types of materials and items that we need in order to perform our services, it can be bad news. Okay, so we would have problems just related to staff. If we're overstaffed, then we're going to have disproportionately high labor costs. If we do that, then we're going to have lower profits due to those additional salaries and wages that we would be covering. We would have increased staff turnover due to the fact that we've got people sitting around bored and they don't have challenging work. Okay, so maybe they were just get over it and get some, ready to get out and go find something else more fun and entertaining to do than sitting there from 8 to 5 working on next to nothing. What if we're understaffed? There would be a lot of problems with that, of course. We would have lost revenues because our existing and future clients' needs would go unmet. And of course, we would have loss of professional staff due to burnout and excessive workloads. All right, so these budgets can be used to better run our organization, which we will see a whole lot more of how we're going to use these budgets in our future chapters. So make sure you dig in deep for chapters 7 and 8.